Hi, this is Michael Bernaski, and this is video 7 in African Mission Healthcare's financial management series. And the next two topics, which will be in the next two videos, are probably the most dense of all the topics in this course. So I think it's very, very useful to listen to them multiple times. And since this is meant to be a Train the Trainer series, it'll be very useful for you to be able to refer back to this content as you try to teach it to others. So when we talk about revenue accounting, the goal overall is to try to have an estimate or a plan of how much revenue our business, our clinic, our hospital, our network is going to be able to um, capture over the next year. And we know up front that our estimates will be wrong. And so some people, question, why should I put much effort into this at all if I know I'm going to be wrong? And it's essentially the answer to that is because how and why we're wrong is very useful learning for planning the following year and for understanding the drivers of growth and profitability within our institutions. And so it's one of those things we do knowing that we're going to be off every time we do it, but learning from those successive approximations to get better and better at forecasting in the future and gain increased control over the institutions that we help to manage. This cube is meant to reflect three dimensions of revenue forecasting or revenue accounting. The forecasting is what you do ahead of time. The accounting is what you do during the year. And obviously you want to do both. Three dimensions. Let's start with the horizontal axis. What procedures will we perform? The vertical axis. How many of each procedure will we perform? And lastly, the depth on this cube. How much will we charge and will we be paid for each procedure? And those are the three dimensions. So if we know we're going to do a certain procedure, let's call it child inoculations, we can estimate a number that we think we'll do. Sometimes we try to estimate with a low bounds and a high bounds and then an intermediate point. So we might say we think we're going to do at least 50, as many as 100, but we'll plan on 75 for those. And then we'll figure out how much we think we're going to charge, and then what we think we'll actually recover or get paid for them. So we might decide, for example, that each child inoculations, we hope to get 3,600 sterling, but we actually expect to recover only 3,000 sterling for each shot, given that some people won't be able to pay or won't be able to pay the full price. Other examples are things like car accidents, which are of course more unpredictable, but have a significant impact on the profitability and the growth of the hospital. And road conditions and things like that can be taken into account. If the road is fixed nearby our clinic, we'll be able to maybe assume an increase or decrease in the amount of car accidents. Now, you might wonder why I said increase or decrease. Well, perhaps the fixed road will make people drive safer and create fewer hazards for them to encounter, but also maybe the increased road will get people to drive faster, which will cause more accidents. It's not always obvious what is going to drive volume here. Another example is something like a burst appendix. And this might just be classified as an emergency surgery or something like that. But having a sense ahead of time of how many of these we expect to see is key. But again, we might replace burst appendix with just emergency surgeries other than those caused by accidents, if you will, and might just try to estimate those as a whole. One example I'm going to use here, I'm going to keep going with, is child inoculations. I borrowed the details on these slides, which we won't go into, in part because I don't clinically understand all of them, but it was pulled from materials here in the US, and there's a product code for each of the commonly administered pediatric vaccines, which is delineated by the product code. And there's a set of manufacturers, and there's branding, and there's a number of components for each vaccine, and all sorts of things that I don't really understand. But all I'm really going to borrow here is the sense that there's various vaccines that could be delivered to children, and that's going to be the unit of estimation that we're going to use. So going back to our cube, we'll start with the first dimension of how many of each procedure are we going to do. And we'll go product code by product code. So if you see 90702, that's the first one on our list over here. We expect to have a low of 100 of those that we're going to perform, a high of 300 of them that we're going to perform, and maybe a mean of 200 that we'll perform. So we have a high bound, we have a low bound, and we have something we're going to use for central planning, which is just the mean bound. And historical results should be a guide. So how many 90702s I did last year and the year before should provide a basis for me to have comfort with my estimate. And that's pretty key. Not only are we going to use these to estimate our revenue, by the way, we're going to use these to estimate how much of each inoculation we're going to have on hand. So they're very key to inventory management and all sorts of things like that. And the range, again, is very important because it allows us to express degrees of uncertainty. So some vaccines we might feel there's greater variability in. So 90702, from the low bound to the high bound, 100 to 300, there's 3 times as many possible vaccinations in the high bound. But 90698, there's 10 in the low bound and 40 in the high bound. So there's statistically more variability in the latter vaccine than there is in the earlier vaccine. And as you get better and better at this, those patterns tend to be pretty important. So the next question is, how much will we charge and be paid for each? Now, sometimes people think this is a fairly simple exercise, but there's a fair amount of strategy behind it. And as you'll see, the first column that I have next to each vaccine is a retail price. Now, a retail price is sort of like a sticker price. It's kind of what we would hope to recover in an ideal world. And we often discount from the retail price, but the retail price for people who can afford it is what we want to be able to charge them. So if you look at this particular chart, some people will be free in the next column. Some people are hoping to recover 50% of the retail price, and some of the people we expect to recover 80% of the retail price. And roughly from a percentage perspective, you'll see I put 25% of the people will likely need to receive the vaccine for free. 50% should be able to pay half the cost, at least half the cost, and 25% should be able to pay at least 80% of the costs. And so while everybody has the same retail price, we're able to get a different amount of revenue from each of these sort of 3 segments of customers. So if we do the math, and I'm not going to walk you through the details of the math, what we see is that if we use our mean estimate of doing 620 vaccinations in a given year, we expect to do 155 of them for free, so therefore we'll have no revenue. We'll expect to do 310 of them at 50% recovery, so we expect to get about 5,000 in revenue. And we expect to do 155 of them at 80% recovery, and therefore get about 4,000. So the total revenue we expect from inoculations is about 9,000 ultimately. And if we do the math, 9,000 in revenue and 620 inoculations, on average we expect to get 1,452 in revenue for an average inoculation. So hopefully that makes some sense to you. The math is pretty simple, but it is a little bit detailed. Now, let's talk about why we might miss our revenue target. Well, there's only a couple sources of missing. One would be, we have fewer or more inoculations in total quantity. than we expect. Maybe it's a high inoculation year because there's been a lot of births, or maybe it's a low inoculation year. All sorts of things could happen. A different mix of inoculations. So as you noted, there were different product codes, and we might end up doing more of a certain type of inoculation than other types of inoculation. And we might also get a different rate of average reimbursement for inoculation. So instead of getting the $14.52 that we had in our model, we might get $13.25 per inoculation as an example. And again, we didn't expect to be 100% accurate, but having the budget, we can assess why we were off, looking at these three categories of reasons, and then use this to manage effectively going forward. Before we move on to cost accounting in the next video, I'm trying to make two summary points here about revenue accounting, but they'll also apply to cost accounting. First and foremost, we are trying to forecast ahead of time as managers and think about how much of each activity we're going to ultimately be doing. And we're also wanting to keep track of how much of each activity we do. And these will help us manage the enterprise, not just financially, but operationally as well. For example, it gives us a sense of how much staffing we might need and other drivers. And it also allows us to report back to various stakeholders, whether they be donors, government entities, or other people that we talk to, being able to show not only that we have good tracking of what we actually do, but our ability to forecast it is something that we take pretty importantly as well, is a sign of our managerial maturity.